Sir, very happy morning to all. In the last slot, my dear lovable students, I have done the introduction to the math. Actually, I have introduced the format of math to you. Now I am going to do the analysis of the math format. Analysis. Why I am adding back, why I am reducing, trying to say maximum logic as possible. We understood that any deferred tax, amount of deferred tax and provision thereof, debited to P&L account should be added back. Deferred tax P&L account debit பண்ணியிருந்தா add back பண்ணணும். Deferred tax P&L account credit பண்ணியிருந்தா minus பண்ணணும். Deferred tax, amount of any deferred tax, if any such amount is credited to statement of P&L, that means deferred tax will not suffer MAT. Deferred tax MAT கட்ட வேண்டிய அவசியம் இல்லை. Prior to amendment, there has been some ambiguity regarding the adding back of deferred tax if debited to P&L account. Now, deferred tax is the tax effect of timing difference. We know that the taxable profit as per the accounts and taxable profit as per the tax will be different. So, in order to match it our straight line method, we are using the deferred tax concept as per AS 22 or applicable in days. Deferred tax contemplates the adjustment in respect of both the deferred tax asset and deferred tax liability. Accordingly, in a case where there are both type of timing difference, asset or liability, both need to be adjusted either on gross basis or on net basis. Either deferred tax add பண்ணி deferred tax minus பண்ணலாம், இல்ல net basis add or less பண்ணலாம். And in case where there is a reversal of deferred tax, that should also be adjusted. That means what is the one line summary? Any deferred tax debited to P&L account should be added back. Any deferred tax credited to P&L account should be removed. Deferred tax adjustment is just a timing difference. It will not suffer MAT. Coming to the next one. Expenditure relatable to an income accruing to a foreign company. That means if the assessee is a foreign company, amount of expenditure relatable to income accruing or arising to an assessee being a foreign company from capital gain arising on transaction in security, because that capital gain will be taxable at a concessional rate of either 10% or 15%, or the IFRS, which is interest, dividend, royalty, fees for technical services chargeable to tax, and the rate in chapter 12, that is 115A. If the income tax payable thereon in accordance with the provisions of this act other than the provisions of this chapter is at a rate less than 15%. So, if you are a foreign company and if you are having capital gain or if you are having IFRS, and if that is going to be taxed at a rate which is less than 15%, then you have to remove that item and the corresponding expenses should be added back, because original tax rate MAT rate விட என்னவா இருக்கு, கம்மியா இருக்கு. Income accruing to a foreign company, amount of income accruing or arising to a company being a foreign company from the capital gain arising on transaction in securities or the IFRS, the rate specified in chapter 12 is such income is credited to P&L account, and income tax payable thereon in accordance with the provisions of this act other than the provisions of chapter 17b is at the rate of 15%. What this adjustment is saying, shall we do one question to understand more about, and we will read back once again. Profit and loss account of foreign company for the year under 31/3/2024. Royalty and fees for technical 20 lakh. Short-term capital gain referred under 111A 40 lakh. Long-term capital gain under 112A 50 lakh. Long-term capital gain referred under 115AB 20 lakh. LTCG on listed shares sold off market 10 lakh. Dividend income referred under 115 back 10 lakh. Expense on earning royalty and fees for technical services 5 lakh. STT and expense on STT referred under SCCG referred under 111A 2 lakh. STT and expense on long-term capital gain taxable under 112A 3 lakh. STT and expense on long-term capital gain referred under 115AB 4 lakh. STT and expense on shares sold off market 1 lakh. Expense on earning dividend 3 lakh. Net profit is 132 lakh. The tax rate in dividend income as per relevant DTA is 10%. Fantastic to the core. This is the problem, because that foreign company, that particular company would have entered into double taxation avoidance agreement. Since they are entering into double taxation avoidance agreement, the rate may be concessional rate. We know that as per 90 subsection 2, either the Income Tax Act or DTA, whichever is more beneficial to the assessor. And my dear lovable students, Kulandak and Chettiar. But if the GAR is saying that the agreement or arrangement is an impermissible avoidance agreement, then DTA provisions will not be applicable, because GAR overrides the entire act, including the DTA. What a knowledge. Thank God. So I am starting with the net profit as per P&L account, 132 lakhs. You know, I am going to add expense on royalty and fees for technical services, 5 lakhs has been debited. Because royalty and fees for technical services, 5 lakhs is going to be taxed at a concessional rate under 115A. For our examination, for our attempt, this is going to be taxed at the rate of 20%. Earlier, it was 10%. This is an amendment they have made. Assume that to make you understand what is the relevance of that. Fees for professional or technical services is taxed at a concessional rate of 10%. Now, that is not the present case. Now it is 20%. My dear lovable students, assume that this is my assumption I am solving. Assume that it is going to be taxed at 10%, which is less than 15%. So that income should be removed and corresponding expense should be added back. So that 5 lakh should be, my dear lovable students, added back. But as per our examination, if you are taking it as 20% right, I will not remove, I will not add it back. Like logically you understand instead of matching with the answer. So that's it. I am assuming that it is going to be taxed at 10%. I have added back this 5 lakh. I have taken this 5 lakhs. Fantastic to the core. I have added back. Now, expense on dividend income disallowed under 115 BAC. Sir, dividend is going to be taxed at a concessional rate of 10% as per DTAA, but the MAT rate is 15%. So dividend is going to be taxed at a rate less than MAT rate. So the dividend credited to P&L account should be removed, and any expenses on earning dividend, that is 3 lakh, should be added back. So this 3 lakh I am adding back. Coming to the next one. STT, security transaction tax, and expense on capital gain not allowed, because STT means here STCG referred under 111A concessional tax rate of 15%, LTCG taxable under 112A concessional tax rate of 10%, LTCG referred under 115AB concessional tax rate of 10%, LTCG on listed shares sold off market, then 112A will not be applicable, taxable at 20%. Dividend income referred under 115 BAC, sir, 10%, 10 lakhs, it is going to be taxed at 10% as per DTAA. Now I am corresponding matching, sir, STT and expense on STCG covered under 111A concessional tax rate of 15%. STT and expense on LTCG taxable at 112A 10%. STT and expense on LTCG referred to 115AB 10%. STT and expense on shares sold off market 20%, because the section applicable is 112 and not 111A, even though it is a super asset. Expense on earning dividend, this is going to be 10%. This 3 lakh we have already added back. Now this is STCG is 15%, so that 2 lakh, then sir, this 3 lakh, then 4 lakh and 1 lakh. So these are the total STT, security transaction tax. Expense on capital gain not allowed. Expense on capital gain not allowed, because I am calculating the MAT. When I am calculating the MAT, this 2 lakh STT is on account of 111A, I am adding back. STT on LTCG 3 lakh, I am adding back. STT on 115AB 4 lakh, I am adding back. Sir, this 1 lakh is I am adding back. So totally 2 plus 3 5, 5 plus 4 9 plus 1 10 lakhs I have added back, and the corresponding capital gain I have removed to deal it separately. What are the capital gain I have removed, my dear lovable students? If you see STCG, this 40 lakhs I will remove because it is going to be taxed at a concessional rate. That's 50 lakhs I will remove because it is going to be taxed at a concessional rate of 10%. This 20 lakhs I will remove because it is going to be concessional rate of 10%, and this 10 lakh I will remove because long-term capital gain on listed share of market. Sir, it is going to be taxed at 20%. No, yes, it is going to be taxed at 20% under 112A. So PGBP income is 30 lakhs. So what I have done, I have taken the net profit. The expenses relating to royalty I have added back. Expense on royalty and fees for technical service disallowed under 115A. Sir, why are you doing? Because this is math. You said that only the rate less than 15% has to be adjusted. No, sir. Sir, I am calculating both. I am calculating both under the normal provisions and the math provisions. Then only I will make you understand the difference between this and this. So here total income as per the normal provisions I am doing first. Then okay, sir. Super, sir. Then after normal provision I will be doing the normal tax liability. After normal tax liability I will do the book profit. Super, sir. So I have taken net profit. In normal route, PGBP income will not cover the capital gain income. Correct? So only the PGBP has to be taken care. So I have started net profit of 132 lakhs. I have add expense on royalty and fees for technical service which are disallowed under 115A. Because 115A will be taxable at a concessional rate of 20% on gross. Expense will not be allowed. So I have to add back. So I have added back 5 lakh. Are you clear with this point? Expense on dividend income disallowed under 115BAC. Sir, dividend income will be taxable under IFOS. The corresponding expenses should not be debited to P&L account. Hence, this is an IFOS expense. I am adding back. STT paid on capital gain. That is an expense relating to capital gain head. All the STT debited, I am adding back irrespective of the percentage, which is 2 plus 3, 5 plus 4, 9 plus 1. My dear lovable students, 10 lakh I have added back. So, this is the other than PGBP items debited to P&L account of foreign company I have added back. Less capital gain dealt separately because this capital gain has to be treated separately. So 40 lakhs plus 50 lakhs, 90 lakhs plus 10 lakhs, 100 lakhs, 120 lakhs capital gain. I have to tax it under the head capital gain. So the PGBP comes to 30 lakhs. Here don't worry about the math calculation and all. This is just a normal route. I have removed the IFOS item. I have removed the capital gain item. Fantastic to the core. Now, what are the capital gain? STCG taxable under 111A 40 lakhs. Yes. LTCG taxable under 112A 50 lakhs. Yes. LTCG referred under 115AB 20 lakhs. Yes. LTCG on sale of shares off market without indexation 10 lakhs. Yes, these are the capital gain, totally 120 lakhs. That means whatever has been removed from the PGBP I am taxing under capital gain. So the total income is 150 lakhs, which is 30 lakhs sir PGBP and 120 lakhs capital gain. Come on, my dear lovable students. I am going to calculate the normal tax liability. Normal tax liability. Tell me, sir, tax on royalty and fees for technical services under the normal route, now it is 20%, but we have calculated 10% For understanding purpose, go with the 10%. So 20 lakhs into 10%, 2 lakhs. Now this has been amended, sir, it has become 20%. Tax on dividend income under 115 AC, sir, here it has been given as BAC, yeah, it is 115 AC. Back is only applicable for normal individual, yeah, right. 115 AC, we know that GDR, it is 10%, which is 1 lakh, dividend income. Tax on STCG under 111A, 40 lakhs, 15% comes to 6 lakh. 112A, sir, 50 lakhs, 10% comes to 5 lakh. Sir, 115AB, 20 lakhs, 10%, 2 lakh. 112, 10 lakhs, without indexation, 10%. Don't say that 112 not 20%. So 1 lakh. So total tax comes to all this put together 17 lakh. Adik mele health and education says this much, and total is 17 lakh 68,000. Sir, okay sir, 115A we can apply how much percent? 20% as per the amendment. Fine. 115AC bond or GDR, I know that 10%. 111A 15%. 112A the income is how much lakh? 50 lakh. 50 lakh. In excess of 1 lakh, it will be taxable at how much percentage? 10%. About 49 lakhs, 4,90,000 pota podum. Because in excess of how much lakh? 1 lakh, the income will be taxable at the rate of 10%. So 115AB 10% and NSR inga 112 10% because there is no indexation. Now I am calculating the book profit. What is the net profit as per P&L? 132 lakhs. 132 lakhs has been given. Less royalty and fees for technical services. LTCG, royalty and fees for technical services. Sir, what is the LTCG given? LTCG is going to be taxed at a concessional rate. What are the LTCG taxable at concessional rate? STCG 15%. It is same with the NSR. MAT should not reduce. Whereas 112A lo 50 lakhs, 115AB lo 20 lakhs, listed off market, since it is going to be taxed at 10% without indexation. Sir, 115AB lo 20 lakhs, LTCG or 10 lakhs, total 80 lakhs worth. 80 lakhs. Plus you are having, sir, royalty fees for technical services. That royalty and fees for technical services come to 20 lakhs. Now we can't remove that 20 lakhs. The reason or the logic is, now it is taxing at 20%, which is more than MAT rate. So I will not remove that part. So as per 2D, my dear lovable students, 110 lakhs is the LTCG, royalty and fees for technical services. So total whatever any as per the class number 2D, this should be added back. How this 110 lakhs they have worked out? Sir, 110 lakhs is, they have removed 110 lakhs. First one, 112A, that 50 lakhs. Okay sir. Then 115AB 20 lakhs. Then 112A cover avale, but enna edukathadanale, indexation benefit edukathadanale, it is going to be taxed at 10%, so that 10 lakh. Then dividend income, sir, it is going to be taxed at 10% as per DTAA, so dividend income is 10 lakh. Sir, 50 plus 20, 70, 70 plus 20, sir, 20, sir, 70, 80 and 90 till now. We know that royalty and fees for technical services, they have considered 20 lakh. So 90 plus 20, 110 lakhs. So this is how this 110 lakhs came. But now that fees for professional technical service is taxable at 20%, we should not remove that. We have to reduce only 90 lakh. And the corresponding expenses should be added back. What are the corresponding expenses you will add back? Sir, this short-term capital gain 15%, I will not touch it because same MAT rate. But this 3 lakh I will add back. This 4 lakh I will add back. So 7 lakh plus NSR 1 lakh I will add back 8 lakh. And expense on earning dividend, sir, 8 plus 3. Totally, how much lakhs, man? This 11 lakhs I will add back. With regard to fees for professional services, my dear lovable students, they have added 5 lakh. But now we will not add. That's how 11 plus 5, 16 lakhs they have added back, and they find out book profit of 38 lakhs. So 38 lakhs into 15% comes to 5 lakh 70,000 into 104% comes to 5 lakh 92,800. Here the tax payable as per the normal route is higher. So tax liability of foreign company is 17 lakh 68,000. Sir, only one change is there in the question. When you have to put the royalty and fees for technical services, you have to tax it at 20%. Hence, no need to remove corresponding expense, no need to add it back. I am going conceptually, so like this a rate may change. That's why I am keeping in the same format. You have to think, you have to understand what is happening. So this is the analysis. Now you read this. This is with regard to expenditure part, and this is with regard to income part. Expenditure relatable to income accruing to. Shall we read the income first? The amount of income accruing or arising to an assessee being a foreign company. From the capital gain arising from transaction securities. Yes, there was one capital gain which were taxable only at the 10%. Because for a non-resident, section 48 is saying that, proviso saying that, 112A is saying that without benefit of indexation, the tax rate applicable under 112 will be 10%. This is less than 15%. And the IFRS, interest, dividend, royalty or fees for technical service chargeable to tax at the rate or rate specified in chapter 12, that is 115A. If such income is credited to statement of P&L and income tax payable thereon in accordance with provisions of this act, other than the provisions of chapter 17B, is at the rate less than 15%. So any income which are going to be taxed less than 15% should be removed from the MAT calculation, and the corresponding expenses debited to P&L account should be added back. The amount of expenditure relatable to income accruing or arising to a company being a foreign company from the capital gain arising on transaction securities or the IFRS, my dear lovable students, sir, in chapter 12, that is 115A, if the income tax payable thereon in accordance with the provisions of this act other than the provisions of this chapter is at a rate less than 15%. I believe that you are having a good understanding of this question. I am moving to the next adjustment of the matter. Amount of, sir, analysis of amount withdrawn from the revaluation reserve. Sir, amount carried to reserve. Amount carried to any reserve by whatever name called in your profit and loss account, my dear lovable students, to reserves created by whatever name called should be added back, because it is not a charge against the profit, it is a appropriation of profit. And amount withdrawn from any reserve. Sir, amount withdrawn from any reserve or provision, if any, such amount is credited to statement of P&L. However, the amount withdrawn from reserve or provision shall not be reduced from the book profit unless the book profit of that year has been increased by those reserves or provision. That means what they are trying to say, my dear lovable students, நீங்க வந்து reserves create பண்ண வருஷம் நீங்க add back பண்ணீங்கன்னா அந்த reservesல இருந்து நாளைக்கு withdraw பண்ணி P&L accountல போய் reserve அப்படினு credit பண்ணீங்கன்னா that reserve should not again suffer the MAT, because already you have added back at the time of creation. So it has to be removed. This is a normal. But with regard to withdrawal from revaluation reserve, this is a beautiful concept. You should have 1000% clarity in this. Withdrawal from revaluation reserve. My dear lovable students, sir, in order to just reduce the net profit, you are looking for various ways. You don't got any way, so you understood that. I will be doing the upward revaluation of an asset. Now, revaluation, upward revaluation. For example, there is an asset, 100 lakhs is the book value. 100 lakhs is the book value. You are going to do upward revaluation. You are going to pass the journal entry. Sir, asset account debtor 100 lakh to revaluation reserve 100 lakh. So you have put another entry for 100 and 100 lakhs. Now already book value 100, revaluation reserve 100. So the total value become 200. On this 200 lakh, you are levying depreciation at the rate of 10%. So what entry you will put? Depreciation account debtor 20 lakh to asset account 20 lakh. So in the P&L account, what you will charge to depreciation, correct? to depreciation, how much lakh? 20 lakh. How much should have been the actual depreciation you should have charged? 10 lakh. 10 லட்சம் ரூபாய் சார்ஜ் பண்ண வேண்டியங்க நம்ம 20 லட்சம் ரூபாய் சார்ஜ் பண்றோம். So the net profit will reduce by 10 lakh. So by revaluation reserve 10 lakh. You have to withdraw to the extent of depreciation from the revaluation reserve. Up you have to pass an entry revaluation reserve account debtor 10 lakh to P&L account 10 lakh. Right? So when you see the revised balance sheet, asset value will be, my dear lovable students, 180 lakhs. Because 100 lakhs was there, 100 lakhs you have added, it become 200 lakhs. You have claimed depreciation of 20 lakhs, so it become 180 lakhs. 180 lakhs. What is the split of 180 lakhs? Old 100 lakh, actual depreciation 10 lakh, remaining 90 lakh. New appreciation, revaluation 100 lakh. On account of that depreciation 10 lakh, the remaining 90 lakh, 90 plus 90, 180 lakh. Here a revaluation reserve was there. You created 100 lakh less from that revaluation reserve created. Reserves withdrawn 10 lakh. So the remaining 90 lakh. That means this 90 lakh and this 90 lakh should exactly match. That means because of revaluation your depreciation has been increased. But the same amount you have withdrawn to the P&L account. Then my dear lovable students, no effect on the net profit. What income tax people are saying that if this is the case, we don't have any problem. But certain company, fraud company, what they will do, you know, they will create the revaluation reserve and they will only enhance the depreciation. To the extent of depreciation, they will not withdraw from the revaluation reserve. Fraud company. So what they are saying, 115 JB MAT format will automatically take care of that. Depreciation, any amount of depreciation debited to P&L account should be added back. Because that depreciation may include depreciation on account of revaluation. Whereas amount of depreciation debited to statement of P&L, excluding the claim of depreciation on account of revaluation should be reduced. For example, in my P&L, total 10 lakh rupees depreciation I have debited, this 10 lakh should be added back. If this 10 lakhs include 4 lakh rupees depreciation on account of revaluation and 6 lakh is a normal depreciation, only 6 lakhs can be reduced. Only 6 lakhs can be reduced. And amount withdrawn from the revaluation reserve, just now I told, because of revaluation of the asset value increases. On that increased asset value, you will claim depreciation. Automatically the depreciation increases. In order to cancel that increased depreciation, you have to withdraw that amount from the revaluation reserve and credit it to P&L account. Then amount withdrawn from revaluation reserve and credited from the statement of P&L, it does not exceed the amount of depreciation on account of revaluation reserve. What is a one-line summary, sir? Whatever depreciation debited to P&L account should be added back. Less depreciation excluding revaluation reserve should be reduced. Less amount withdrawn from the revaluation reserve to the extent of depreciation on account of revaluation. Sir, that means one add back, rendu minus. One add back, rendu minus. Sir, I want more discussion on this. Don't worry, I am doing. Sir, withdrawal from reserve can be classified into two categories. Withdrawal from any reserve or withdrawal from revaluation reserve. If it is withdrawal from other than revaluation reserve, check only one condition. Whether have you added back while calculating MAT earlier? If yes, reduce while calculating book profit in the current year. No. Not added back earlier while calculating MAT. No adjustment because it has not suffered tax earlier. Let it suffer tax now. Clarity concept? Right. With regard to the withdrawal from revaluation reserve, you have to check to the extent of depreciation on revaluation credited to P&L, then reduce that while calculating book profit. Not credited to P&L, no adjustment is required. I am making a superb analysis here. Enjoy that analysis. Suppose the P&L account of company for the year ended 30/1/2024 is as under: sales 2 crore, expense 40 lakh, depreciation 25 lakh, net profit 1 crore 35 lakhs. Oh my God. In order to reduce book profit, company revalued the asset by 300 lakhs. So the value of asset would have been increased by 300 lakhs. And assume depreciation rate as per the Companies Act is 15%. So 300 lakhs into 15% comes to 45 lakh. Already we are charging a depreciation of 25 lakh. So 25 lakhs plus 45 lakhs comes to 70 lakhs is going to be the revised depreciation. Revised P&L case number 1. What is the sales? 20 lakh, 2 crore. Sales is not going to change. Anyway, it is the same. By amount withdrawn from revaluation, 45 lakh. Good boy. That means to the extent of revaluation, the company has withdrawn from the revaluation reserve and credited to P&L account. Super. To expenses 40 lakh, no change. To depreciation has been increased to 70 lakhs because earlier it was 25 lakh plus addition of 45 lakh. That's how it becomes 70 lakhs. So revalue pannadanaala depreciation increase ஆயிருக்கு. In order to reduce that depreciation, company has withdrawn from the revaluation reserve and credited to P&L account. It has become tallied. So the net profit is become 1 crore 35 lakh. So before revaluation also same profit, after revaluation also same profit. Fantastic to the core, sir. So this will be the computation of book profit under case number 1. What is the net profit as per P&L? 1 crore 35 lakh. At depreciation debited to P&L 70 lakhs. 70 lakhs. I have to add back. I will be having 1 add back and 2 minus will be there. Less depreciation excluding revaluation because 70 lakh minus 45 lakh I will be getting, sir, 25 lakhs will be the normal depreciation without revaluation. Whereas amount transfer from revaluation reserve to the extent of depreciation on account of revaluation 45 lakh. So 70 lakhs add panta, 70 lakhs minus panta, 1 crore 35 lakhs is the book profit. Now you may have a doubt. 70 lakhs adhe add pani adhe 70 lakhs less pandradha irundha. Look at the second circumstance, then you will know. Revised P&L case number 2. Certain company, fraud company will do like this. By sales 2 crore, to expense 40 lakh, to depreciation 70 lakhs, which is original of 25 lakhs and revaluation 45 lakh. Net profit 90 lakh. That means by doing the revaluation process, they have increased the value of the asset. And on that increased value, they calculated the depreciation, and that depreciation has been debited to P&L account. So there was an increase of depreciation, and the corresponding depreciation increase has not been withdrawn from the revaluation reserve. So, sir, are you saying that that amount is still staying in the revaluation reserve? No. In case number 2, company transfer 45 lakh from revaluation reserve to general reserve by the following adjustment entry. Fraud pay. Revaluation reserve P&L account P&L account credit side net profit effect same. But they have passed revaluation reserve account 45 lakh to general reserve account 45 lakh. So government. Now after the amendment, book profit under 115 JB shall be computed as under. This is with regard to case number 2. You tell me what is the net profit as per P&L? 90 lakh. Add depreciation debited to P&L 70 lakh. This is full depreciation, including the depreciation on account of revaluation. Less depreciation excluding revaluation of asset. Excluding revaluation, totally 70 lakhs debited, 45 lakhs is the depreciation excluding revaluation, so 25 lakh. The second part, amount withdrawn from revaluation reserve to the extent of depreciation on account of revaluation. Yedume withdraw panla, adnala dash. So book profit become 1 crore 35 lakhs. Their book profit also 1 crore 35. Your book profit also 1 crore 35. That means a MAC format taken care of normal company and fraud company. If the company is a normal company, I have to add back one item. I have to reduce 2 items in order to counter the add back. But in case of a fraud company, I will be add back 1 item and I will be reducing only 1 item. So automatically depreciation on account of revaluation will be automatically added back. What a clarity, sir. Fantastic to the core. I am moving into illustration number 2. ANM Limited furnishes the following particulars for the year ended 31/3/2024. Net profit before depreciation 300 crores. Less depreciation 75, of which 50 crores for revalued asset. Net profit after depreciation 225 crore. Withdrawal from revaluation reserve credited to P&L, nothing. They have withdrawn nothing. Fraud company. Because to the extent of 50 crore, they should withdraw. Compute the book profit in accordance with 115 JB for assessment year 24-25. So I am calculating in the base. Net profit is 225 crores. This is the net profit after depreciation. Add depreciation debited to P&L. Total depreciation including the depreciation on account of revaluation. Less depreciation excluding revaluation, that is a normal depreciation 25. less amount transferred to revaluation reserve. Anga nirthala. To the extent of depreciation on account of revaluation is dashed because nothing has been withdrawn. So the book profit is 275 crores. Basic enna nadakuduna, what is the reported net profit? 225 crore. Plus how much unnecessary depreciation you have added back? 50 crore. So 225 plus 50, 275 is the correct net profit. So my book profit is 275 crore. Fantastic, sir. They are giving alterations. Would your answer or book profit computation differ in the following circumstance? Amount withdrawn from the revaluation reserve 25 crores. எவ்வளோ rupees? Sir, 50 crores depreciation debit பண்ணிட்டு எதுவுமே withdraw பண்ணாம இருக்க வேணாம்னு சொல்லி 25 crores என்ன பண்ணிருக்காங்க? withdraw பண்ணிருக்காங்க. குட் கம்பெனின்னு கேட்டா அந்த அளவுக்கு குட் கிடையாது. இப்போ ரீவாலுவேஷன் ரிசர்வ் என்ன பண்ணுனாங்கன்னா வித்ட்ரா பண்ணாங்கன்னா this net profit will change. Why it will change? Because the new item is going to be credited in the P&L account. Automatically 300 crore net profit ங்கிறது 25 crore add ஆகி 325 crore ஆயிடும். ரைட்டா? So from there I should start. So here automatically 225 plus 25 போட்டா 250 crores ஆயிடும். So the starting point will change. I hope that this change you have noted. Add depreciation debited to P&L, total depreciation 75 crores. Less, my dear lovable students, depreciation excluding revaluation, that is a normal depreciation 25 crore. 25 crore. Less amount transferred from revaluation reserve to the extent of depreciation of revaluation 25 crore. 25 crore. So 275 crore is the book profit. So what, sir, mistake you have done? You debited 50 crore depreciation, you credited 25 crore from revaluation. So 25 crore net debit you have enjoyed. What is the resultant net profit? 250 crore. 250 plus 25 come to 275 crore. Book profit remains the same. I hope that you are able to appreciate. They are saying amount withdrawn from the revaluation reserve 50 crore. Good boy. 50 crore debited to P&L as depreciation. 50 crore withdrawn from revaluation reserve. Done. No effect will be there. So 50 crore அவங்க டெபிட் பண்ணாங்கன்னா 225 crore 275 crore மாறிடும். கரெக்ட்டா? So 275 crore net profitல I have to add back the total depreciation 75 crore. Reduce the depreciation excluding revaluation, normal depreciation 25 crore. Less amount withdrawn from revaluation reserve 50 crore. The book profit will be 275 crore. Now look at that, 75 crore they have withdrawn. That means very good company. Only 50 crore depreciation they have made. But sir, instead of withdrawing 50 crore, they withdrawn 75 crore. That means one line is there. This is the relevance. The amount transferred from revaluation to the extent of depreciation on account of revaluation. அப்ப நீ P&L 75 crores credit பண்ணா கூட 50 crores தான் மைனஸ் பண்ண விடுவ. Remaining 25 crores you have converted a capital profit into a revenue profit. For that pay the tax. So இப்ப இருக்கிறத விட 75 crores withdraw பண்ணிருக்கேனா 225 plus 75 become 300 crore. You will add back the total depreciation of 75 crore. You will reduce the depreciation excluding revaluation reserve 25 crore. Even though you have withdrawn 75 crore, we will not allow you to withdraw 75 crores, my dear lovable students. We will allow you to withdraw only 50 crores because the amount withdrawn from revaluation reserve to the extent of depreciation on account of revaluation. So 50 crores debit பண்ணிருக்க 75 crores credit பண்ணா கூட 75 crores minus பண்ண விட மாட்டோம். 50 crores தான் minus பண்ண விடுவோம். That means அந்த 25 crores எங்களுக்கு மேட் வேணும். So the net profit, since you extra withdrawn 300 crores will be the net profit. The amount of net profit as P&L account shown above has been increased to the extent of revaluation reserve credited to P&L. According to 115 JB, amount to be reduced in respect of revaluation reserve credited to P&L shall not exceed the amount of depreciation attributable to revaluation. Accordingly, in situation of a C above, whether the company has withdrawn 75 crores from revaluation reserve, same has been restricted to 50 crore being the amount of depreciation in respect of revalued reserves. Fantastic to the core. We have analyzed, sir, much. So my dear lovable students, I'm coming man. These are the analysis. Sub number 1. The first analysis saying that any deferred tax debited to P&L account or deferred tax credited to P&L account, it is just a timing difference. Deferred tax debited to P&L account should be added back, credited to P&L account should be reduced. Then we have understood a beautiful topic called as, sir, with regard to foreign company. Sir, is foreign company, have they credited any item which are capital gain? Because under section 112 they are having an option without taking the benefit of indexation that a non-resident can pay tax at the rate of 10%, which is less than 15%. If that capital gain is credited to P&L or IFRS is credited to P&L, which is going to be taxed at a rate which is less than 15%. If it is exactly 15%, don't do any adjustment. That's what STCG 111. Alright, then those items should be removed and the corresponding expense debited to P&L account should be added back. That's what this question is all about. Fantastic to the core. In that, only one thing you have to highlight is for our examination fees for technical services and royalty has been enhanced from 10% to 20%. That means those items should not be adjusted while calculating the matter. Super. That is an amendment. Now, amount withdrawn from reserve is a beautiful topic, man. Sir, withdrawal from reserve, you have to analyze what type of reserve, whether it is a normal reserve or revaluation reserve. If it is a normal reserve, you have to check at the time of creation, have we added back? Yes, we have already added back. Then, at the time of withdrawal, no need to again pay the tax. Remove it from the net profit. Sir, I have created through the balance sheet, not through the P&L account. That means it has not suffered tax at the time of creation, my dear lovable students. Then it has to be suffered tax. Now leave it as it is. No adjustment is required. With regard to withdrawal from the revaluation reserve, check have they withdrawn to the extent of depreciation on revaluation credited to P&L. Then reduce while calculating book profit, because you will add back. Sir, one add back. Whatever depreciation debited to P&L, you will add back. Right? You will add back. You will reduce two items, my dear lovable students. Two items you will reduce. Number 1, depreciation excluding revaluation, and less amount withdrawal from the revaluation to the extent of the depreciation on account of revaluation. In order to counter this one add back, you will remove two things. If the company is a good company, it is a normal practice. The same item you are adding back, same item you are reducing by two names. But if the company is a fraud company, automatically they will be caught. Look at what a clarity. I believe that you are enjoying. It's not a just format where net profit as per P&L account and income tax paid or payable. No, man. We are killing the topic, Matt. Why? Why add back? Why add back? Study like this, then the preparation will be very level. Sir, my dear lovable students, the last analysis. Brought forward or unabsorbed business loss. Two things we have already there. The company may be a normal company, or company may be a sick company, or who has applied for corporate insolvency. Sir, aggregate amount of unabsorbed depreciation and loss brought forward in case of company and its subsidiary and the subsidiary of subsidiary, where the tribunal on application moved by central government has suspended the board of directors and appointed new board of directors. They have removed the board of directors and they appointed the new board of directors. Or company against whom an application for corporate insolvency resolution process has been admitted. Then it is not brought forward business loss or unabsorbed depreciation. It is aggregate amount. That means brought forward business loss plus unabsorbed depreciation, because a company is going to insolve. அவங்க எதுக்காகனா சார் கார்ப்பரேட் இன்சால்வன்சி ரெசல்யூஷனுக்காக அப்ளிகேஷன் கொடுத்திருக்காங்க. அவங்களோட brought forward business loss carry forward பண்ணி அவங்க என்ன பண்ண போறாங்க? So let them enjoy both brought forward business loss and unabsorbed depreciation. Both let them reduce. Still, if they are having book profit, let them pay the tax. Otherwise, don't disturb them. Allow them to be happily enjoy. Whereas brought forward business loss or unabsorbed depreciation in case of other company, normal company whose directors has not been changed or who has not applied for corporate insolvency, either the brought forward business loss or unabsorbed depreciation as per books can be reduced, because they are having life. They can carry forward for next years and they can set off. There is no time limit. Fantastic to the course, sir. Amount of brought forward loss or unabsorbed depreciation, whichever is lower in case of other company as per books. But if one of the item become nil, either brought forward business loss or unabsorbed depreciation, then whichever is lower than it, automatically that point will become nil. And what the math is saying, that profit of sick industrial undertaking. If the company is a sick industrial undertaking during the sick period, kaachal period la math vaangade. So the amount of profit of sick industrial company commencing from the previous year, means the company becomes sick. Endha varsham kaachal vandirukko. And ending with the assessment year during which the entire net worth of the company equals to or exceed the accumulated loss. Don't levy math. So this is the special analysis of the math. You know one thing, my dear lovable students, now we can happily do 10 to 15 questions from math. And when I start doing 10 to 15 questions, the level of clarity on the math will be very level. No one can give this much clarity in math. We will enjoy that. What you are supposed to do is you have to just revise the introduction part and analysis part. Now the connecting will be very level. If you are enjoying, express your happiness, my dear lovable students. I'm waiting for that. Then we'll be doing another 10 questions from math. With that we can say that we are through with math. I'm waiting here.